inclusion in global indices. Now, before I start, I do want to remind everyone the audience to remember to vote for the live poll. If you have a question already, please put the vote in, and towards the end of the panel, we will review the results and we can discuss a little bit more whether it's in line with our panelists here as well. So, I'd like to extend my welcome to our director, Brad, portfolio manager from AB, and then Bojo from Bloomberg, and then King from CICC, and George from BPCC. Thank you so much.
So as you all know, China is actually a very large market. It's actually second largest stock market in the world and third largest bond market following US and Japan. And over the years, there has been great interest for the China bond to be included in the global indices. And recently, I think it was on the 7th of March, which Mark alluded to earlier as well, was that the city has already announced that it will include China's onshore bonds into the emerging markets and regional indexes. So I was just wondering, what are your views on the development of the future global benchmark, bond benchmark, and how did the inclusion in global indices actually impact the price discovery mechanism? We can have an open discussion, or Bo might be in a better position to start off with.
Sure. Both from Bloomberg, because we have an index business. For those of you who are less familiar with all the different business lines of Bloomberg, about 1 year ago, we acquired Barclay indices, which formerly known as the Lehman indices, where Ping actually traded them when he was in New York. So since then, Bloomberg now operates one of the biggest, maybe the biggest fixed income indices in the world. And we recently announced, and actually it took effective on March the 1st, when we introduced the two new indices. We didn't include the RMB bonds in the global aggregate yet. So we created two new indices. The first one is global aggregate plus RMB bonds. And it's already available on our terminal. RMB bonds represent about 6% of overall index, which is a very significant weight. The second one we introduced is emerging market local currency government bond index plus RMB RMB bonds, which RMB bonds represent 40% of the index. So, which is too significant to be an index, and we have another copy of it. It's capped at 10%. These are important interim steps when we are considering the final inclusion of index. Now, as any index company, obviously I'm speaking for my personal view. I don't represent the index business. I run our trading platforms. But for any index business to consider to include a certain market, the decision is driven by our set of clearly published and communicated rules of index inclusion, which you can find on our index website or information. Second is based on the client feedback, like Brett here, and on our discussion about potential inclusion, right? So Bloomberg has a big global operation. So let me start with the client feedback. And in the past 6-9 months, especially after Mr. G mentioned the opening of the interbank bond market when they introduced CIBM program. Consistently, we have heard from our global players, they are either allocating more money of their existing funds into the RMB bonds, or they're preparing to launch new funds that invest in RMB bonds. This has been consistently the voice from the global investor, and we see more and more of those funds coming up. And now, in terms of the second was the set of the criteria we published why it's not including in the final indexes yet. And many of them have been actively addressed by the regulators in China. The latest one was the FX swaps, right? And that was announced maybe a week ago. That's one of the major reasons that the RMB bond hasn't satisfied the criteria of final inclusion yet. And taxation issues, as Ms. G also mentioned about. One additional point is, right now the offshore investors still cannot access the RS markets, which is serve as one way of hedging. Overall, they need a more effective way of rates hedging, which is not open yet. So I think they may be considering that as well. Now, when the rules are met, we also expect another period of time when the offshore investors start to interpret the existing rules, and it's time to absorb all these new regulations and put into the real practice where you actually get a fund started or really did his first trade or so, then the investor will be more comfortable about the final inclusion. Now, this said, I don't see the global index inclusion as a final destination or the ultimate goal. I see this as a critical path to the final conversation of global asset reallocation. Because right now, China, all the offshore investors probably only have very, very tiny allocation into RMB bond market. The foreign holding is only 1 to 2%, right? But this morning I checked the CGB yield, 10-year is 3.3%. And I checked JGB, it's Japanese bond market, 10-year is 0.08%. You know, the question that we get from the Central Bank of Japan was, can you handle the negative yields on your platform, right? So in any comparison, CGB is an attractive asset class. Even the yen, the FX volatility on yen is way greater than RMB. But there are practical challenges why the offshore investors are not allocating more money into the China market yet. You know, index inclusion is a critical path to trigger this conversation. You know, in 3-5 years, I hope, maybe sooner, then those conversations could happen at CIO level, head of asset manager level. When they look at their overall asset allocation, they could, at a senior executive level, they can make a decision saying, I need to allocate 5-10% into China, rather than I need to allocate 5% into a zero yield. Yeah, I'll comment on the price discovery later. Yeah.
Thank you so much, Fred. Fred, do you want to comment a bit about the...
Sure. So index inclusion would attract some funds, obviously. And it's sort of been a bit of an elegant solution for index providers to take the sort of the baby step to producing these global bond plus China. So it allows global investors to sort of not invest into China unless they were to change their benchmarks. Nevertheless, I think you're right. It has created the conversation, and increasingly there is interest from offshore investors, institutional and retail, to access this very large market. Size isn't everything though. We have to be. There's been a lot of presentations about the size of the market, but also the rate of growth of the market. And I would say that for a lot of our institutional clients, the rate of growth of the China bond market is probably viewed as a slightly negative development rather than positive. It's great to have a big, deep, liquid market, but the rate at which it's growing is sometimes marked as a cross rather than a tick. But I would think that this is an interim step, and the investor feedback that the index providers seek, again 6 months ago was strongly opposed to China bonds being included into global benchmarks. But I think if we were to have that round of discussions again towards the end of this year, that the proportion of votes voting in favour would have moved some distance.
I think the inclusion of the Chinese bond into any global index is a hugely positive development. I think it's good for the global investors to understand the Chinese bond market better. And I also think it's a very positive turn for the onshore market to become more developed and more mature. And I think our market is still young, and I think a lot of the things are not up to the Western investor standards. The inclusion index will definitely put more scrutiny on the price and discovery mechanism. And I think one thing will make the pricing of the index more precise. But right now there is a domestic bond index. It's published by our clearinghouse. And I don't think it's that precise now. I came back to China 6 years ago. I worked at City Securities on the fixed income side. And 6 years ago, the bond index pricing is not precise. Now it's more precise, but still not precise. Sometimes you hear traders talk about, this bond is trading at 30 bits above the mark. What does that mean? Yesterday's market is 3.5, now it's trading at 3.8. You cannot move that much in one day. So it means yesterday's market was not right. So if you include the Chinese domestic bond index, the global index, it definitely will put pressure on how the domestic index is marked, and it will promote more interest. It will promote more active market making. The biggest part of our bond market is the direct market. And unlike the exchange market, the price discovery is OTC, it's negotiated transaction. And we have a lot of market makers. Trust me, when I work at City Securities, none of my traders want to be market makers. It's tough, right? It's hard to make money. It's tough, right? I tell them, don't worry about the P&L target, I can, if necessary, I can give a negative budget. Market making is tough. Nobody wants to do that. And the regulators come up with a lot of incentives to promote market making. It hasn't worked that well. And now, I think the positive development I saw in our market, a lot of times is from foreign investors. Right? When we try to serve the QT clients, our QT clients, they put a high emphasis on secondary market making activities. And our biggest issuer clients, like the China Development Bank, they put a lot of emphasis on secondary market making. Right? The development bank, we talk to them, what's big underwriting for them? Well, my previous show was big underwriting for them. They would regularly call us up saying, I need you to do more to make secondary market. And more and more my investors wants to the dealers to make secondary market. I think increasing the index will be another approach in that direction to make it much more transparent, to make it much more liquid in the secondary market. I think inclusion in the index is good all around. It's good for the domestic market development. It's good for price discovery. It's good for the more precise market of domestic index. I think I can't wait to see that. The Bloomberg index, I have a long history with bond indices. I started trading Lehman indices in '97. I was at Lehman. I started with the mortgage index, and then gradually we expanded to the government index. And when the CDX comes along, we start making market with the corporate index, the Lehman index. And the demand was huge. Trade total return swaps. I think getting to 2004, 2005, more and more demand came from fund business. They want to buy a lot of bonds. And one way to define it is that the hedge fund industry, when they go after institutional money, they usually go for the alternative investment allocation, which in the pension plan could be 5-10% allocation. And funds start going after fixed income allocation. They say, give me a fixed income allocation. I can buy a billion index from Lehman, and I have a lot of alpha. I can overlay to a bond index. And to satisfy the demand, we even create a tracking index, which looks like a Lehman Act, but it's all derivatives. It doesn't use my balance sheet, and I can unlimited amount. It was a huge demand. I think the index development is going to be huge. I think right now the Chinese bond index is not tradable. I will not put my money on the bond.
Not yet.
Not yet. So with help from Bloomberg, maybe we'll do it someday.
Yes, no, definitely. Thank you for sharing your thoughts here. Definitely enjoy hearing that. The other thing that's also attracting a lot of interest over the past years is that you can see that China is actually expanding quite quickly and allowing more and more foreign participation. So through the programs like QFI, RQFI, CIBM registration, and then Stock Connect, and more importantly, what I want to talk about today is the Bond Connect. So, just wanted to see, your perspective, due to the uncertainty, like nothing's really being talked about Bond Connect yet. So, what are your, I'd like to discuss your perspective on what exactly do you see as potential benefits or challenges on the Bond Connect, and basically we could compare it with, what we've learned from the Stock Connect as well. Maybe.
So we'd all, I think, agree that the details of Bond Connect are a bit sketchy at the moment as to what it's finally going to turn out as. Our experience at Alliance Bernstein, we started investing in the onshore market via the QFI program. First of all into the exchange market and then into the interbank bond market. I think we were one of the first to get our interbank bond license there. So we've invested in the QFI. We've then gone and applied for and received our RQFI and got quota through that process. We've then gone and got quota through the new China Interbank registration process. And the benefit of hindsight, it's sort of been a bit of a frustrating exercise because of the different regulatory frameworks and processes at work. Even all the paperwork and administration and things that you do to get QFI can't necessarily be used to get RQFI. So I hate to think of the millions of renminbi spent trying to keep up with the rate of change that the policymakers here are doing. I am a little nervous that Bond Connect will then allow us to throw the lawyers and the accountants out again to set ourselves up to get hold of Bond Connect. I would encourage any policymaker here to try to maybe streamline the whole process or collapse now non-useful programs into at least one. That's a wish, of course. If Bond Connect does allow foreign investors access to the very large interbank bond market, or even if it's just the exchange market, I guess that would be welcomed by China as an additional source of financing. And similarly, if Bond Connect allowed onshore Chinese investors to seek investments outside of China, the southbound route, that would also be welcomed by global managers who have products to offer them. But I think at the moment the details of the sketch, I do see reports that Bond Connect is not just about maybe the buying and selling of securities, it's actually how they are settled, and that could mean some greater connectivity between settlement systems in China versus offshore settlement agencies, and we would certainly welcome that.
So, on that note, maybe I can, we all agree that we're still waiting for more details to be released so that we can make a calculated judgment about how we are going to take up the challenge on the Bond Connect in terms of post-trade operations. But I think all of us agree that the best way to look at or to forecast the Bond Connect operational challenges might be, looking back to the challenges we have faced with the Stock Connect in the past 3 years. So, for those of you who have been, participating into the, Shanghai Shenzhen Stock Connect in the last 3 years, I mean, things like beneficial ownership, things like a non-DVP settlement flow, all these things are still, in place even 3 years after the launching of the Shanghai Stock Connect. But luckily, by working with my colleagues in CFAX, that I can share a little bit encouraging news or sign that I have experienced by talking to the market operator like CFAX. that they realize that there's gaps. There might be gaps between the domestic settlement flow with the global normal practice, and they are working very hard to try to bridge the gap, try to bring in the global best practice. So it seems like a beneficial ownership because it's a real name registry system in China. So that issue should not be too challenging for the forthcoming Bond Connect, even though we don't know what type of method will be used in the Bond Connect. Talking about DVP, that would be a little bit challenging, but less challenging than the Stock Connect, since in CIBM it's a DVP settlement flow in either T or T+1. So other than that, from our perspective, we have been working with CBES in the last 6 months, trying to build up some solution for the global investors to come into CIBM, particularly in the post-trade space. I mean, I couldn't share a lot of details since we are bound by the NDA agreement signed. But one thing I can share with the audience in the room today is hopefully in the next couple of months that we can make some external announcement which will help people like Brad and all other foreign investors come into CIBM and following the existing post-trade operational flow to the Korean settlement while using the help of Asian Bank in China.
As Brett mentioned, you lived through the real pain of applying for every single program. For any market, any local market, when it opens itself, one characteristic is they often introduce different capital programs or different market access programs along the way. And most of the time, the most recent program will be an enhanced version of previous ones. These are what we see from the QFI to CIBM. Now, there's no details about Bond Connect, but I would expect that there will be enhancements of solving the current trading and operational challenges. And Ping mentioned a little bit about this price transparency. And Bloomberg has built literally our core competency in fixed income of providing the pricing transparency for all the global investors, right? From our all-Q, all quotes ecosystem, literally allow the offshore, the buy side, and see all the pricing transparencies from the sell side, and consequently, then force the sell side to provide more competitive pricing, right? So we're very experienced in this space globally, and when it comes to offshore investor investing in China, there's a few critical steps when they make trading actions, right? Start from price discovery to negotiation, then to ticketing / post-ticketing settlement. Right now, this process is very manual, and it's separated, and it's inefficient, right? We have a lot of experience in other markets, in U.S. Treasuries, global developed markets, in some of the Asian markets. We have a lot of experience to automate those steps into a streamlined workflow. Now, this said, any connect program, to connect someone to another local market will be a challenging program. I literally, for any major capital markets in Asia, I have sort of connectivity project ongoing right now. All those projects will be across time zone, cross language, cross culture, cross technical systems. So anyone who are running those project programs will have a lot of difficulties to overcome, and in order to bring efficiencies for someone who has used to the global operational standards and used to have efficient workflow to the China market right now, which actually have a great framework because a lot of things are centralized. but many of the steps are still very manual and not automated enough, right? Another point I want to add is the pricing transparency, because that's also a difference between the offshore investors' habits versus what's happening in domestic China. So most of the offshore community has a very structured community. You have clients trading with dealers, and dealers trading with through the brokers or through some electronic broker now. I was a market maker for US dollar RS. You're right. It's not a good job. It's a tough job. But China actually, in some way, it already evolved into a all-to-all. Everybody trades with everybody. There's not a very strong presence of market maker, kind of flat structure, where a lot of information is centralized in interbank brokers. So its own ecosystem is slightly different from what the global investor used to. So a global investor has expectation on the dealers, the market makers, to service them, to provide liquidity, right? And so how does, when more and more offshore investors join the army market, does that change the domestic dynamic? It's yet to see. But what we observed is right now China has two groups of dealers. And one group is those global dealers who has strong distribution globally, has a very sophisticated operation in terms of sales, client engagement, in terms of their technology, in terms of their internal system. But the shortcoming, they don't have a deep balance sheet. So they don't have many bonds to sell. The other group is the domestic Chinese banks as a market maker. They have very deep pocket, huge inventory, but their operations according to Ping, they're still young, right? They're young in terms of servicing the clients. They're young in terms of set up on efficient operations to expand their business. So I think that both groups going to evolve, and as to who will be the major one, maybe the major, but overall inclusion in the index, opening the bond market will all help them to be a stronger market maker, and then there'll be more offshore investor like Brad will come join the army market.
Yeah, so with respect to liquidity, the market is not that liquid certainly for an offshore investor at the moment. But I am optimistic. Without giving away my age, I did start dealing in bond markets back in 1993 in Australia, and back then the Australian bond market was heavily dominated by the four major banks. There was no real offshore investor base, and it was really only the development of a defined pension system which forced the domestic saver to move into the bond market, which created some demand, which sort of, I guess, eroded the power of the banks as the price maker. It did attract a new investor base, and then of course the Japanese money arrived, and now I think ownership of the Australian bond market has been up with the high 70% since back then, the 60% odd now. I'm not suggesting that's where we get with China, but at least we do have some examples of where the introduction of a new marginal investor can change the behaviour of so it's more the flow that changes the behaviour of the stock. There is examples of that as well.
I just add to my colleague's comment. I think the motivation for Bond Connect might be to attract more capital inflows. As a domestic asset manager, is more interested in the southbound part of the Bond Connect. I see the relative value in Hong Kong rather than the domestic bond market. But anything which helps incorporate the Chinese market into the global market, I think is good. So I think that's what we do. We don't know the details. The Bond Connect has been whispered for a long time until yesterday, when Premier Lee said we're going to do it this year. So it's a pretty concrete timetable. I think we're going to see details. I'm sure George will be involved. When you're walking through the if you walk through the details, how to sell and how to compare, our settlement system with the offshore settlement system, just walking through the details will help the domestic market, which in turn will prepare the Chinese market to be more attractive to foreign investors. I'm looking forward to see more details of that. But I think, first, I'm not sure you're going to attract a lot of inflows. In fact, see more funds set up to go down.
Just to add to Ping's comments, if we refer to the Stock Connect, the southbound flow only picked up when the Chinese regulator allowed institutional investors in China to participate into the Hong Kong Stock Connect. And also later in the process, we have seen the volume-wise, southbound volume surpassed the northbound volume. There were a lot of reasons behind all these changes, most people would agree that if you look at the overall market performance in Hong Kong and Shanghai stock market last year, basically Hong Kong being one of the best performing market in the world, versus A-share being one of the worst performing market last year. So it's really depending on the market return as well as the investors' interest level. So there's still going to be a lot of things that we need to watch out for. But from my personal perspective, the whole bond connect thing will definitely be something very exciting, and will be driving up some liquidity in this market, which is really something that the regulator wants to see.
Yeah, thank you so much for all your views. That's a very fruitful discussion just then. So we did touch upon, actually you guys already touched upon the next question I had was about the operational challenges in the CIBM. The other thing that I did want to ask about, like the uniqueness of China is that not only do they need to, what we call we need to trade through the monetary seabed systems, but we also have a T+0 settlement rule and also the pre-funding requirements. Now, these are unique to China specifically, which is slightly different to, the different markets around the world. Now, from a post-settlement perspective, at a T+0 settlement rule, how does that impact your operational flow and what are the challenges there? Obviously, as Bill alluded to earlier, the time zones, that's all going to be a bit of a challenge. So, from that perspective, can you share a little bit about that?
Yeah, once again, there's just limited information available right now about how you're going to set up your fund or operation as a global investor and trading into CIBM. So the best thing, the thing we can look at is really the experience we gathered from Stock Connect. Yeah, one thing if you look at the Stock Connect in the last 3 years, around 70% of the investment are coming from Asia, from this part of the world. And basically, there is certainly some legal hurdle which prevented some UCITS fund to participate into a Stock Connect, and also some time zone difference, particularly for some US-based managers to participate. But nevertheless, from operational perspective, each market has its own, settlement cycle and all the requirements, clearing requirements. I guess from what we learned from Stock Connect is, home country rule will still prevail. When the global investors come into CIBM, they still need to appoint a local agent bank to do the settlement on their behalf. Even if we're talking about the operational deals, based on the thing we have seen in the past, from QFII, RQFII, and also the after last year's announcement, number 3, a circular announcement, that the agent bank, appointed agent bank, need to do the confirmation on CFA system on behalf of these foreign investors. So that these type of things we don't foresee will be changed dramatically, even after the Spot Connect will be launched. But certainly, as I mentioned earlier, I want to reiterate. The encouraging part we have experienced so far is, our colleagues in CFAX, they realize that there are some operational gaps between the domestic flow versus global best practice, and they are working very diligently, try to bridge the gap, and hopefully, with the help of technology and better understanding of each market's practice, we can work together to limit the gap, and so that foreign investors will overcome the challenges like time zone or legal operational hurdles. But again, it's just limited information available now, so I'm just taking my best guess.
We talk a lot, the Bond Connect generated a lot of buzz, obviously, because Premier Mini mentioned about it. But I do want to emphasize the CIBM program literally opens the entire interbank bond market wide open to all offshore investors. So by verification right now, it's literally everything's ready. There's nothing stopping you from going in there. There are operational challenges in the sense people need to learn how to go in practically, right? As Mr. G mentioned, the regulations are in different files, and there's no, I haven't seen it yet, the stepwise, say, step 1 do this, step 2 do that, right? So, and we talk to the offshore investors a lot, and for them it's also a learning process to understand any new capital program. And many of the questions we were asked is very basic, and we were like, what? So there's the education process, and then the agent bank, right? The model, it was introduced before to help the offshore investors to enter China bond market, because for our, let's say, a fund in Europe, they may not even know where to start. So agent bank is like when you buy a house, and that's your realtor to start with, right? And so today, maybe there is efficiency by that model, but you call it agent bank in other markets. Some of function they play, I call it fixed income sales, right? So I think let's not to fix on the names or those things. Let's look at what's the real problems here. And there are rooms to be improved in terms of providing more automated workflow, to provide more pricing transparency, etc. But no matter what's it called, I think we all after the same thing: a more transparent market, more liquid market, more automated and streamlined workflow.
I definitely agree. You kind of summarized everything. That's definitely what we want to see in the China bond market. Okay, so the other question that I did want to, it's a very broad question. We kind of mentioned already a bit. Do you think China bond market is ready for foreign investors, which you've already just covered as well? But the thing is, what about, let's say, market infrastructures and obviously national regulations and language barriers? Do you guys, from your perspective, maybe given both are different perspective, do you think it's ready?
Whether you're sort of a Chinese investor or an international investor, one of the key drivers of the investment is if you're going to make money. So I'm optimistic that Chinese policymakers have a clear ambition to open up the China bond market to foreign investors. So the operational aspects will be overcome. It might take some time, and firms like ourselves are launching onshore China bond funds next week to actually put this theory into practice and live the experience. So we can then go to our global investors and say, look, this actually works. This is what's happening. we've ironed out the issues. So I'm optimistic about the operational side. Is China government bonds a good investment in the current environment? Yes, there are grounds to support, as a global bond investor, an institutional bond investor. If you look at the real rate of Chinese government bonds relative to other developed market bonds, if you look at the volatility of the Chinese government bond market relative to other markets, then it clearly does warrant some investigation. So for me, yes, I think that there is grounds to support an investment. If actually we go and do some back testing and look at the Bloomberg aggregate index by itself, and then we look at the Bloomberg aggregate index plus China, and the risk-adjusted returns of that Bloomberg plus China look quite attractive. And then if we look at the performance of that new index, say in periods when the S&P 500 falls 10%, because you want your bonds to be defensive, then again the Bloomberg aggregate index plus China seems to serve just as good a purpose. So, I think when we go to talk to our clients, if history is a guide to the future, it's never exactly going to happen. But there are reasons to support an investment into China government bonds in the current environment.
And again, maybe can contribute a little bit about this. How do the asset managers, locally here feel about foreign investors coming on?
The more the better. I think my belief is that I think foreign investor interest and investment in the domestic bond market brings positive development. Brings more best practice and how we do things, and how the broker-dealer make markets, and how the issuer listen to market demand. The foreign money has been invested in China bond market for a number of years now. The central banks, the sovereign wealth funds, they have been the pioneer in the investment. They don't have to go through the QT or RQT, they just go directly to the PBOC and get the quota, they get the investment in Chinese bond market. To Melissa's question, is China bond market ready? I think, it's going on. I think it will get better. Will attract more investors. I think right now, I remember 2 years ago, I was at a Sigma panel discussion in Singapore. At that panel, there were a lot of interest in Chinese domestic bond market, but it's not very open. Well, back then, I think the value story was more convincing. I think the Chinese Treasury yield curve versus U.S. Treasury yield curve is 250 basis points. Now it's probably 100 basis points, and plus the RMB is in depreciation trend, so the value is not there. So that's why I'm more interested in southbound. You guys see value over there. For my domestic investor base, for my clients, $1 bond in Hong Kong, convert back to RMB is more attractive. It's more attractive. But I think the opening up, the interest, the China Connect and everything, I think is good. It prepares China to be a more developed market, and to be a more efficient market, and will make it more attractive to future investors.
Yeah, just actually, in terms of Chinese government bond hedged back to US dollars, or even just unhedged, its spread in nominal terms isn't attractive as historically. Versus JGBs and bonds, slightly different scenario. But in terms of one thing that we are watching closely is, and we've seen examples of it today, where if, on a macro perspective, if, say, Chinese currency stability relative to its basket is a current sort of policy goal or objective, then that, if it sort of becomes like a Singapore light model, then all of a sudden Chinese monetary policy becomes closer to the US, and we saw that today with Chinese policy responding to the Fed. So all of a sudden, if I have looked at history and said that Chinese government bonds add diversity to my portfolio because they have a different monetary policy cycle, I think we need to think about if policymakers want currency stability, that might negate the interest rate diversity if it becomes just more connected with the global cycle. So just an observation, so it's something that we're looking at.
Yeah, as Ping said, right, the market moves, and yuan moves, the interest rate moves, right? But right now, I think a lot of discussion when people want to go into China bond market is not about the market yet. It's about operations, about the access, right? We need to overcome that hurdle. So when offshore investors, when they are talk about China bond market, they don't have to worry about how to go in. Then they can focus on their investment decisions, right? So get ready. First, you need to technically ready and infrastructure-wise ready, and then people will consider come in. With this said, let's not to mistakenly think, oh, once I launch the program, then all the money will come in. And once you launch a program, people will feel they can come in. And then when the market condition is right, which actually changes pretty fast, right? And then the money will come in. And it's market cyclical, and so the regulators, the market, the China market need to be prepared for that.
Yeah, that's a very good point. Given we've got about 10 minutes left, that actually brings us to our poll question. Let's have a look at the results of the poll question, which is allowing, I think, what is the top priority to attract global investors to invest in China interbank bond market, and it is the B. The highest is STP for cross-border trading and settlement. Is that in line with your views? Maybe we can go around the table, beginning with maybe George.
Wow, this poll result made my work easier, talking to our clients. Yeah, I'm not surprised that the answer more focused on the trading settlement STP flow. Basically, if you look at today's globalized market, basically people are talking about new technology like blockchain, AI, all sorts of new technology. People are talking about trying to reduce human capital to save money for the bottom line. All this all add up together is people, no matter coming from the developed market background or has been working a long time in the developing market, came to the consensus that definitely the proven workflow or procedure can help the firm or the end investor by the end of the day to get a long-term positive return. So a lot of firms have been putting a lot of pressure, rather focus on set up the STP flow. And if you have a proven track record of operational flow, which works perfectly in the US or in EMEA or in the major Asian market, you simply want to copy that when you are moving to CIBM. So this has been the focus in our conversation with people like CFAS and the Chinese regulator. And unfortunately, we got a lot of buy-in from our counterparts. So hopefully, with the market moving along, that the global STP process will be introduced in China.
Not much to add there, but I think we all agree that getting the pipes open, I'm optimistic about. and we are going to try to experience that as much as we can. But I think we also have to be aware that, similar to say SDR inclusion for currency status, there was clearly an objective to get there, and we went and ticked all the boxes to get there, and there was a big announcement, and then. So again, if someone has the objective of global benchmark inclusion, that's wonderful, and we'll all go and tick all the boxes to get global benchmark inclusion, and one day it will happen. But it doesn't necessarily mean that the funds will flow. If I think of the last 3 global bond mandates that we have won, they have all been customised benchmarks. Yeah? So it will be a European pension fund will just say, yes, I want the Bloomberg Barclays Global Treasury ex China. Yeah? I want the Bloomberg Barclays Global Treasury ex Peripheral Europe. Yeah? I want the Bloomberg Barclays Treasury 15% JGB capped. So just in getting into a big benchmark, sure, there might be some passive managers and some structured products that follow it, but the big pools of actual physical money, if they are not convinced that the pipes are open, then no announcement will change their mind. They will just exit out.
If you truly believe B is the most critical one, then please voice up to the decision maker. I can only say, if B one day becomes a real possibility, then Bloomberg can easily make that your dream become true instantaneously. We have services in all those areas and ready to go.
Okay, we've got 2 minutes left. I'd like to ask the audience if anyone has any questions, whether they can just raise their hands or can also submit through the online. Does anyone have any questions for panelists? Yes?
Hi, my name is Nick Dvorak. I just have a question, maybe I think addressed to Brad, but the others can jump in as well. The bonds, when they're bought by a foreign investor, are subject to withholding tax, I understand, it's not very clear. Is that a factor that you take into consideration? And when you have an index, the fact that a bond is subject to withholding tax, but the index doesn't treat it as one which is subject to withholding tax, does that actually change the appetite for the bonds? And is that something worth looking into?
It changes my appetite because it makes it very hard to outperform my benchmark if I'm net versus gross. But yeah, there are a lot of bond markets that are subject to taxes. Korea is 15.4%, in Indonesia is 20%, in Thailand is 15%, and there are our US domiciled accounts pay tax on Japanese. So we actually go and buy the sort of quasi-sovereign Japanese government bonds. In terms of, again, I don't think put your hand up if you've seen it, but there is a document circulated that foreign investors will be exempt from all tax on Chinese government bonds and local government bonds, but they'll be subject to 10% withholding and 6% VAT on policy banking corporate bonds. So a 16% tax on those markets. Nevertheless, if you think about the spread between a Chinese government bond and a CDB, a policy bank bond, if that's trading at 70 odd basis points, and if you net that yield and the net yield is higher post-tax over the CGB, then there's still advantages potentially to owning the policy bank bond. So I think that there is, so far as I'm aware, clarity around what the tax is for foreign investors, and it's zero for China government bonds and local government bonds, and 16% for policy bank bonds and other things.
Well, it's actually time's up right now. But I do thank everyone, especially my panelists, giving us very, their expertise, insight into our topics. So thank you all for your time and attention.